Or you say the flattening yield curve, maybe not as bad for equities as some people think. Why not?
It isn't. That's what the numbers suggest. Now, Brian, when it comes to investment advice, there's rhetoric and then there's facts. Rhetoric is telling a story about how a flattening yield curve is a macroeconomic concern and it tends to pretend weakness for stocks. Then there's the facts, which show that the equities have never done better based on the current combination where the level and direction of the yield curve currently stands. In fact, how we measure it, the S&P 500 has averaged a 16.5% gain over the next 12 months based on the current level and direction over going back 40 years of history. So to say that a flat curve is bad for stocks, it's fake news, Brian, to borrow from POTUS there.
Fair enough, but let me, Gina, I will say this. I agree. Ari's got facts on his side. Those are powerful things. However, I think people get concerned about a flattening yield curve because it can become an inverted yield curve. Is that correct? I mean, that's the thing. Like, we've got to get flat before we get inverted, and inversion can mean dire things. Not always.
That's like being worried about a bear market bottom because it's going to lead to a bear market top. There's strength in between, and we don't know how long that strength is going to last. We're not at an inverted curve.
No, we're definitely not. I'm not saying we are, or we will get there, Gina. I'm just saying I think that's why some investors are concerned about the flattening yield curve. Agree? Maybe disagree with that.
No. I actually do agree with that. However, I'm going to take some issue with one element that Ari says. Ari, there are facts, especially when explaining causality between numbers. There are facts and then there are factors. And the fact is that the yield curve is only one factor. And if you look at the particular time period that actually results in that number that you mentioned, which is that the S&P 500 on average goes up between over like 16.9%, I think was the number that I saw, during a time when yields are between 0 and 1% and the yield curve is flattening. The reality is that particular time period is only one episode, and that episode lasts from 90 until 1999. Right? And that was a very specific time period when you had a tremendous amount of liquidity being unleashed into the markets. That liquidity found its way into the internet bubble, and that bubble basically inflated through that time period. So if you look at valuations for the S&P 500 at the beginning of that time period, they were fairly low. They ended fairly high, right? That's what led to that stock market return, right? It really had nothing to do with the flattening of the yield curve. Where we are now, though, is we're in a completely different situation where we're toward the end of a very long bull run that really was inflated by fiscal stimulus, and we're now experiencing the actual recovery from that.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.